Now let's take a look at using Prime Trade Select to select option trades. And I've been using the Prime Trade Select for many years to also select option trades. And I've been using it for more than 28 years. And I started small. In the beginning, I only had $4,600 in my trading account. I was trading options when I first started out. But within my first 2 years, even though I only started with $4,600, I had more than $460,000 in profits trading options. And these are snapshots of my copies of my tax returns those first 2 years, showing my profits from options trading. Now, the greater return potential associated with options is due to the leverage that options provide. Let's look at some examples of this leverage. And of course, this works both ways. You can also lose on options at a faster rate than just owning a stock, because the options are so leveraged that it provides leverage both on the upside and downside. So while you can realize a greater profit over time using options, you can also realize a greater loss. But let's just take a look at the leverage that options provide. This is a option chain for Hewlett-Packard stock, and that was trading at the time around $32.78. So if you buy the 35 call option, at the time it was selling for 10 cents. And let's assume that Hewlett-Packard stock increased 10% in price after we bought that option, and from $32.78 to $36.05. Let's just take a look at the leverage that that option would provide. So the leverage that we purchased for 10 cents would be worth $1.05 if there was a 10% up move in the stock. So that 10% up move in a stock, if you're a stock investor, you'd have a big investment. You'd have to invest $3,278 to buy 100 shares, and if it moved up 10%, you'd have a small profit. Now, if you're an option investor and you bought that 35 strike call option for $10, if the stock went up 10% to $36.05, that $10 call option is worth $105. So you'd have a 950% return on your option investment. So obviously the leverage that options provide allow you to get a high return with a small movement in the underlying stock. And what I did is, in this table, is I showed the price movement of Hewlett-Packard stock. So if the stock trades up to 36, you can see that the stock profit would be about 9.8%, and the profit on an option would be about 900%. If the stock moves up to 38, you get 15.9% return for the stock, 2,900% for the option. So you can see the option return can be much greater than the stock return, and of course the risk is also higher. Now, one of the advantages of option purchases is that your risk is limited to the purchase price of the option. So it's strictly a limited risk trade when you purchase a call option. And what that means is you can't lose more than your initial investment. And you can't get a margin call from your broker asking you to add funds to your brokerage account because it's a limited risk strategy. So the most you can lose is the purchase price of the option. As opposed to other investments where you can lose more than you invest initially. This is the case with futures or Forex trading or shorting stocks. So I advise not to be in that type of a situation where an adverse move suddenly overnight because of overseas events could wipe out your trading account. So I found it's much better to limit your trading to limited risk trades in which you only risk your initial investment. And you can't get a margin call if you take limited risk trades. So now let's look at how we profit with options. Options are derivatives that they derive their value from the price of the underlying stock. The intrinsic value of a call option, for example, will increase 1 point for each point the underlying stock increases above the strike price. So the price movement of the underlying stock is actually what determines the option's value and the resulting profit and loss. So our goal is to select stocks that are moving up in price, and we use Prime Trade Select to do that. So if we can select a stock moving up in price, purchasing a call option on that stock allows us to realize big profits and harness that the leverage that's provided by option investing. So the goal is to isolate stocks that are moving up in price and purchasing a call option, and if you're right, that leverage can allow you to realize a pretty good return. So we want to use Prime Trade Select to find these stocks that are moving up in price. And I showed you, I'm going to show you a couple of examples here of options that I purchased using Prime Trade Select. And in this example, I purchased 15 Apple October 130 strike calls at 14 points, and I used Prime Trade Select to select this option. So what we're going to do is look at the profit potential for this option versus just owning the stock. So you can see that the how options are leveraged and can provide a higher return. Here's another example. This is for FCX, and purchased the June 65 strike call at 720. And again, I use Prime Trade Select to select this option. And here's one more. This is for Express Scripts. I bought the June 80 strike call using Prime Trade Select at 1018. And Express Scripts has since had a stock split, so this is prior to the split. I bought the June 80 strike call. And you can see Express Scripts was making a series of new 52-week highs. It was on a buy signal. You can see the 50-day EMA above the 100-day EMA, and we had an upsloping on-balance volume line. So let's look at the option profits I made on these three trades compared to owning the stock over the same period of time. So my brokerage confirmation shows that I sold those Apple call options. I had a $24,000 profit on those call options. And over the same period of time, the return for Apple stock was 13.8%. So I had a 116% return for the option, and over the same period of time, the stock had a 13.8% return. So in this example, the option delivered leverage of 8.4 times greater than the stock return. So the option was leveraged and produced 8.4 times more profit or more return than simply owning the stock. Here's a graph of that. We can see this is the option return here, 116% versus the stock return of 13.8%. And I sold the two FCX and Express Scripts options. I had a $9,000 profit on FCX and a $12,000 profit on Express Scripts. And for FCX over the same time period, the stock produced a 14.8% return. The options produced 126% return. So, again, that was leverage that was about 8.5 times the stock return. And for Express Scripts, it was 119% return for the option versus 15.4% for the stock. And the options work just as well in down markets than they do in up markets. And we can purchase put options on stocks that are in a prime trade select downtrend, and we look at the same indicators that we look for purchasing call options. They're just in reverse for taking bearish trades. And in the last two bear markets, I used this prime trade select to select bearish trades, and we did very well during the bear markets. And let's look at the real-time results over the last 4 years for options. Again, there was over $1.8 million in profits and average return of 85% with about 91% winning trades. Here's a snapshot. This is actually of my Trade Monster account. And in this account, I had a $22,000 profit, average return of 198%. And I'll just kind of go through these. These are copies of my brokerage account showing this $1.8 million in profits. So I'll kind of just go through these quickly. Had an 85% average return on these options that were selected using Prime Trade Select.
Chuck, have you found yourself steering away from stocks and gravitating more towards the option arena more and more as more liquidity pours into them?
Yeah, that's a great question. Is it better to use options now rather than stocks? And to answer that question, Tom, I use a combination of both because I trade covered calls, and when I trade covered calls, of course, you're buying the stock and selling an option. So I use a combination of stock purchases and option trades with the covered calls. And then as far as directional trades, I like to mix it up, and I'll buy both stocks and ETFs, and I'll also purchase options on stocks and ETFs. And I like to mix it up to stay diversified. So to answer your question, I do trade options, but I also trade the underlyings, and I like to mix it up just for diversification in my retirement account. So I have a combination of both stock purchases and option purchases. Here's a snapshot of my advisory service, the option portfolio. We currently have $85,000 in open trade profits, average return of 123%. So that concludes the presentation for today. I want to thank everybody for joining us, and if you want to take a look at my advisory service and look at the current profit results, just log on to weeklyoptionalert.com and click the trade results link up here, and you can see the current trade results. So that concludes my presentation for today, and I'd be glad to take questions that anybody comes up with. So
yeah, sure, Chuck. We have tons of questions. Just a couple quick ones for you. When using the 52-week high list, you utilize the Keltner channels to basically comb through these positions to see your entry points. Do you tend to go back to favorite positions just because you feel like you know these companies better, with earnings and things of that nature? Or do you just tend to go blindside and just look at these quantitative analysis, if you will, and then just attack them with entry points as you do with your options and stock?
Yeah, that's a great question, Tom. What I like to do, watch list of the stocks that qualify under steps 1 and 2 of Prime Trade Select. And then by looking at that watch list every day, if I see a stock retrace, I'll take a look at that stock on Keltner channels, and if it's retracing towards the middle or lower channel, then that usually provides a good entry point. So I maintain that watch list based on steps 1 and 2 of Prime Trade Select on Yahoo Finance, and then when I log on every day, I just look at my watch list portfolio, and if there's a stock or option that I don't own, I'll go ahead and pull the trigger when that stock or option, stock or ETF retraces a little bit and starts to trade down towards that middle Keltner channel, and that's worked out really well because I find stocks that are in strong price uptrends by the fact that they're making new 52-week highs, and then I like to just wait a little bit so they retrace and provide a lower risk entry point. So I look at that watch list every day and then look for some retracements to jump in.
When it comes to purchasing of call options in regards to your system and your strategy here, I know everyone's different. Everyone has different pockets and different levels of risk. But do you typically put on a certain time frame for your calls, Chuck, or how far out do you go in time typically when you go after something that just made that 52-week high list?
Yeah, that's a good question. How far out do you go with the options? And to answer that question, Tom, I like to stagger my option expiration dates just to diversify my portfolio. So I'll have some, I actually also trade weekly options, so I'll have some weekly options in there. I'll have monthly options, and I'll also, I like to mix it up with leaps options. And I found that way that if there's a hard sell-off, and I'm diversified across different time frames like that, it makes it much easier to survive that sell-off if I have some longer-term positions in there that I'm way ahead on. So I can just sit through the sell-off and just maintain those positions if I'm pretty far ahead. So I like to stagger the expiration dates because you never know when that rally or sell-off is going to occur. So if you mix it up like that, it just kind of diversifies your portfolio, and then you can take advantage of rallies when they occur, and you also don't get hit as hard with sell-offs. And I noticed that my covered call portfolio, when we have these big sell-offs, does not go down as much as the general market because the short options in that covered call portfolio, they profit as the stock is moving down in price. So if you have a big down day and that covered call is in the money, if the stock is down 2%, you may only lose 0.5% or even less on that covered call position because of those short options. So I like to mix it up, and I noticed in particular the last several years that the covered call portfolio doesn't have as much volatility as a directional trade portfolio because you have that short option in there. But to answer your question, I think it's good to stagger those expiration dates from monthly and maybe a 3 and a 6 month call option, and then also a leaps option. So I like to mix that up because you never know when that downturn is going to happen, and if you have longer term options that you're way ahead on, you can just simply maintain them.
Makes a lot of sense. I know there's a lot of questions out there for you, and this is exactly why Chuck has posted up this page. Again, you can view trade results. You can take a look at the portfolio. You can contact his support staff. You can contact Brad. That's his toll-free number. He can give you assistance on that as well.